Hello, guys. My name is Joseph Ejike Oji. I hope you are enjoying your holiday. We are still in this lecture that we have today. We are still under risk and return concept, and our topic today will be on portfolio risk and returns. I will begin with portfolio return. So again, we are still under the concept of risks and return. And our topic will be portfolio risk and return. So like I said a few minutes ago, I'm going to begin with portfolio return. When I say that, I mean the expected return on a portfolio. Remember that when we say portfolio, we're referring to a collection of assets like stocks, bonds, cash, and cash equivalents, life insurance policy, property, and other assets. So when they are collection together, if you invest in a collection of those assets, we say that you are investing in a portfolio. Now, the expected return on a portfolio is simply means, when we say that, it simply means the weighted average return of the individual stocks in the portfolio. So the weighted average, that means the averages when you factor in the weight. When I say weight here, I mean the size of or the percentage of the assets that contain that portfolio. Sorry, the percentage of the assets of the individual assets in the portfolio. That's what weight means. I will give you an example here. Let's say that you invested, you have $2,000 to invest, and you invested 500 in Bank of America, 500 in Capital One, and 1,000 in Walmart. These are your weights. So that means that you invested 50%, 30 to 25% in Bank of America, 25% in Capital One, and the remaining 50% in Walmart. So those percentages are the weights. So when I say the weights, you can see what I mean by that. The percentage of the individual assets, individual stocks or bonds that make up the portfolio is what we refer to as the weight. So having said that, I will repeat that the expected return on the portfolio simply means the weighted average of the return of the individual stocks in that portfolio. So this is the formula we use for it. Expected return on a portfolio, we use RT for that, is the sum of, this symbol represents the sum of weight of the individual stocks or the individual asset in the portfolio times the return on that asset. So RJ is the expected return on the individual stocks, and WJ is the weight or fraction of the percent of the value of the stocks in that portfolio, and N is the number of assets or stocks in that portfolio. Now, asset means, like I said, this it can be stocks, can be bond, mutual fund, whatever it is. Now, say from J to and starting for the first asset or stock, the last asset, which is the N. Now, let's look at an example. I hope you guys can see my screen. Okay, good, very good. I'm gonna close some. Let me close this part. Let me close this one, so we can have enough room. Okay. Now let us look at an example. I want to make sure you've seen it. Okay. The first example we're looking at is this one here. Okay. It says, the question says, a portfolio consists of assets A and B. Asset A makes up 1/3 of the portfolio and is expected to return 18%. Asset B makes up the 2/3 of the portfolio and it is expected to return to earn 9%. What is the expected return on the portfolio? Remember that the formula is sum of the weight times the returns. So here they give us the weight. The first weight they give us is 1/3 for asset A, and the return is 18%. For asset B, they give us the weight up to 2/3, and the return is expected to be 9%. So what is the overall return for this portfolio? Let's put this information in Excel and calculate this. Okay. Starting with asset A is 1/3 with a return of 18%. So you have 1/3 with a return of 18% for asset A. 1/3, that means equals 1/3. Okay. So remember in Excel to do a calculation, put equal sign first. And the return of 18%, which is 0.18. And then for asset B, we have 2/3 of the portfolio, and it is expected to return 9%. Okay. 2/3, which means equals 2/3, means 2/3. Press the enter key. And the return of, oh, excuse me, I put it in the wrong place. So the weight is 2/3. So equals 2/3. Press enter key, and the return is 9%, which is 0.09 if you write it in decimal form. So to find this formula, said weight times the return. So this is the session said weight times return. Let's do it. Equals sign to we make this cell ready for work. The weight is this times the return of 18% for asset A. Okay. I should put them in parentheses so that it will follow order of operation. So that the weight of A times the return of A, okay, close parenthesis, plus another parenthesis, the weight of asset B. Well, this first one is okay. Okay, then I just copy it down. So you do the calculations for the second part. Okay, so that the portfolio return, which is weight times, this is sum of weight times return. That means sum of this. It equals this plus that. As is asset A, asset B. Press the enter key, and that will give us the return. Change into percent, 12%. So the return on that portfolio is 12%. So that we can go here and put our answer as 12%. I'm sure you enjoy this. I'm very sure you enjoy this. So you can see that it's very simple to calculate portfolio return. I use only a portfolio that consists only of 2 assets. But in real life, you have portfolio that comprises of many assets. That is when you can now do more calculations. Now, I'm going to use real life data, real life companies, because I like to use them, for example, so that it won't be as if we are only making up theories and theories. Let us apply this to real life company. The same thing that some of these asset managers are doing in this for you in the stock market. You can do it by yourself by just following my example. So look at this question. It says, make sure I've seen this. There you go. A portfolio, suppose you begin to manage a $5 million fund from January. Let me make it, oh, it's okay. 2021. The fund consists of 6 stocks: Bank of America stock, Facebook stock, Walmart stock, Home Depot, Ford, and Johnson & Johnson. So for this fund, you have to invest $5 million. So the amount of investment in each stock is shown in the table in Excel. So let me show you that. So the amount of investment in these stocks, you can see it here. You can see this is Bank of America. You are invested $350,000. Facebook, which we use a symbol is Meta. Remember, Facebook has changed the name to Meta. Meta, I'll call it holding company. Yeah. Anyway, 500,000. Then Walmart is $450,000. Home Depot, $2,500,000. For your own reason, you can decide to reshuffle this amount of investment in each company. Then Ford, you invested 700,000, and then for Johnson & Johnson, invested. For me, I will input $2 million. I'll make my highest investment in either Walmart or Johnson & Johnson. But that's, by the way, just I want to show you how to use real life. So this is money you invested. And so the question goes that you want to calculate this return. It says, what is the expected return on this portfolio? Now, I'm going to use, like I said, I'm going to use real life data. So I'm going to get the stock prices for all these companies so that I can calculate their returns and then use the return to calculate the return on that portfolio. Okay. So let's do it. Give me 1 minute. I'll copy this. I'll check something. See how it works. Oh, didn't work. Undo. Undo. Okay. All right. Now, first needs to like I said, get the prices of all these stocks. So I'm gonna take you to a place where you can get the prices. I'm gonna use the beginning price and the ending price. My ending price would be the stock price today, which is 28th of December. My beginning price, I'm gonna use the stock price in March of this year. So you can use January. I just want to start from March, just my preference. So let's start with the first company will be Bank of America. Yes, so I'm going to take you to Yahoo Finance where you can get it. Okay. The finance.yahoo.com. Okay. So the beginning, I'm going to use Bank of America is BAC, as the same Bank of America Corporation. And I'm going to use the historical data. For this, I'm not going to use daily stock price because it is too noisy. So I'm going to use monthly stock price, my preference. You can use weekly stock price. You can use daily stock price. It's up to you. Starting from December 28, 2021 to December 28, 2022, we'll apply this. So this is the total stock price. This is the opening price, highest price, lowest price, closing price. So I'm going to use the adjusted closing price because it has factored in the value of the dividends that is paid. You can see dividends. So I'm going to use the adjusted. That's 2.81 Bank of America for the December 28, 2022, which is the ending stop price 32.81. So I'm going to go and put 32.81 for Bank of America. 32.81 at the ending price. Okay, the beginning price. Let's look at the beginning price. The price at from March of 2022. Remember, that is my preference. At 5.04. 35.04. Okay. So let me go and put it there. At 5.04. 35.04. Now, that's Bank of America. This one is the Facebook, which is Meta. Okay. I'll look at Meta. Type Meta, which is Facebook. Okay, Meta platforms. Then I'm going to use the historical data. Again, use monthly price and December 2021 to December 2022. Apply it. Okay. So I just said close. That's for today. It's 115.90. 115.90. Okay. 115. And then price 115.90. Numbers you see here are the old ones. So I'm just updating them. And the beginning price, which is the price during March of this year, March 31st. March 31st is 161.25. 161.25 for Meta. So I'm taking the 161.25. 161.25. So next is Walmart. Okay. Remember, like I said, these numbers are what I used before, past stock price. So I'm updating them with the current one for the time frame that I'm using. Walmart is WMT. Okay. Walmart Incorporated. Historical data, monthly, at the same period, December 28, 2021 to December 28, 2022, and apply it. I just said closes. For Walmart is 141.41 for the ending, 141.41. So 141.41. And for the March of this year, it is March 31st, 151.20. 151.20. So it is still the same 151.20. This one is the same, so I don't have to change it. Now for Home Depot, HD, Home Depot Incorporated, using the historical data and the monthly. Apply it. 315.91 for the ending price, which is for the price today. 315.91. 315. Remember, this as I'm doing this is 3:30 p.m. So by this prices might change by the time the stock market closes today at 4:30. So what you use what you have to get what you are looking for. And the beginning price, which is the price in March for Home Depot, Home Depot. Price in March for Home Depot. March 31. 269.15. 269.15. Then next one is for Ford. Okay, Ford Motors. So Ford is F plus F. That's a trading symbol for Ford. Using historical data and monthly prices and apply it. And just close for today is 10.97. Okay, $10.97. 10.97. And then the price in March. Okay. Price in March of this year is 13.78. 13.78. 13.78. Last not complete there is the your portfolio is Johnson & Johnson. JNJ is the trading symbol. Johnson & Johnson is JNJ. Okay. And for historical data, and then they apply it. Oh, excuse me, I'm gonna use monthly. Apply it. 176.90. $176.90. So which is 176.90 for today. 176.90. Okay, and the beginning price, which is the price in March. 176.90. Okay. March. 176.97. Yes, 176.97. Oh, it's right there already. Okay. Now, with this, we are ready to calculate the return on this portfolio. Remember that the return on a given portfolio, the formula for calculating it is sum of the weight times the return. Okay, sum of the weight times the return for each weight of each individual stock times the return of that stock. Do it for all the stock in the portfolio and then add them. That will give you the expected return. Which means that to do this one, we need to find the weight of each of them. The weight, to find the weight, we need to find the total amount. Remember, this is the $5 million portfolio. According to the question, it says that you are given, you have to manage $5 million fund. And that these are the where you invested that money. So let's add our total, make sure it corresponds to 5 million. Let's add the sum, put equal and type in sum. Okay, double click on sum and then like this. Okay, enter key, see 5 million. So the weight for each of these can become, to find the weight, each of them divided by 5 million. So I have equals this stock divided by 5 million. So to make this thing stand, make it stable, I'm gonna put dollar symbol here. Okay, so that each of them will be divided by 5 million. It will not start to change. Okay. All right. Enter. And then, as I copy it down, it will do the rest, all of them. Giving us, when you add them together, right? The sum, copy this sum here. It's $1, not dollar, just 1. So I'm going to format this cell, make it just a regular number. Okay. See? Now, these are the weights. It's what, Bank of America is 7% of the portfolio. Facebook is 10%, Walmart is 9%, Home Depot is 50% of the investment. Then Ford is 14%, and Johnson & Johnson is 10%. So that's the weight. Now with this, let us find the returns. If you remember that the formula for finding the individual return is this. Return is ending price minus beginning price plus dividend divided by beginning price times 100%. Now, because we use the adjusted close price to adjusted closing stock price, we don't have to worry about dividends. So we're using ending price minus beginning price divided by the beginning price. That's 100. So having said that, having said that, we can now go to work here and calculate the returns. Okay. The return will now become equals, we have ending stock price minus beginning stock price divided by beginning stock price. So beginning stock price. Okay. And then we can copy this down to calculate the rest. Okay, so these are the return for each of these stocks. Now to find the return times weight, return times the weight. See, this is the weight here. If you remember, the formula is weight times the return. So let's do it here. Equals, weight is this. I'm going to times the return of this. That give us this. This form didn't perform well. I can see it right now. So so now if we copy it all down, you see the returns with our returns. So that's total portfolio return now becomes the sum of these returns equals sum. Okay. I'll copy this all down. That gives you the press the enter key. The return is this. Make it percent. Okay, percentage. 1.99%. Even though the market is down. When you look at this, I'll make it. So you look at this, all this, make it percent. Okay. Right click format cell and make it percentage. If you return, most of that negative. But because the is a portfolio, one return can bring it here. If it is individual stock, you are losing money, but because it's a portfolio, you still gain 1.99%. So the return for this portfolio is 1.99%. See, sum of the weight times the return. So for this portfolio, return is 1.99%. Okay, it's low, but market is down overall. So this is how you do it. If you have many stocks in that portfolio, this there's a way they can make it. Put in the formula in the Excel, so that as the return, the price changes, it will automatically be calculating the return. That is what most of these asset managers does for their clients. And I believe you got the point now. Having said this, we are ready to go to risk, correlation, diversification, and risk for two stock portfolio. Now, we use correlation to assess the tendency of two variables to move together. And we usually we calculate what is called the correlation coefficient, denoted by rho, to measure this tendency. Now, here are a few things you need to know about correlation coefficient in relation to stock return, to risk and return. But the first thing is that the correlation coefficient ranges from +1 to -1. +1, 0 to -1. So plus one denotes that the two variables move up and down in the same direction. That means if one increases, the other one increases. If one falls, the other one also falls. Then -1 means that the two variables move in exactly the opposite direction. That means when one is up, the other one is down, and vice versa. Now, a correlation of 0 means that the two variables are not related to each other at all. Now, so given these two things, we need to when we want to estimate the correlation, estimate the correlation from a sample historical data. We use a formula method, or we can use Excel method. Now, I want to show you, okay, the principle behind diversification, and to also to show you that the portfolio risk, diversification reduces the risk, but it depends on how you diversify the portfolio. If the diversification is based on a portfolio that are positively correlated, it's not a good diversification. You're still going to lose a lot of money. But if they are negatively correlated, that's a good one. I'm going to show you that. So look at this. First look at the correlation of and diversification in a two-asset portfolio. Now, adding a risky asset to a safer asset can reduce risk. So in a two-asset portfolio, the portfolio risk can be computed using this formula. So this is delta. Delta P, that means portfolio risk is square root of weight of asset A times this delta P, which is the standard deviation. We use standard deviation as a measure of risk. So DP is weight of asset A times the standard deviation of asset A, which is the risk, plus weight of asset B times the standard deviation of asset B, plus 2 times weight of asset A times weight of asset B times the correlation between asset A and B times the standard deviation of asset A and the standard deviation of asset B. Now, this might look like a monster formula, but actually you understand it when you use it. It's very simple. Where the standard deviation of asset A and B represent the risk, and WA and WB is the weight. I've already explained what the weight means. Then delta P is the portfolio risk. Then rho AB means the correlation between asset A and asset B. Okay. Now, portfolio risk can be minimized, I have said it before, by diversification. But the degree to which this risk is minimized depends on the correlation between the assets that are being combined in that portfolio. Now, if you're combining assets that have a negative correlation, then the portfolio risk can be eliminated. So, and when I say negative correlated, it means that when one move up, the other one move down, and vice versa. But if you're combining two perfectly correlated portfolio, whereby the correlation is positive, that is two positively correlated portfolio, that will not reduce the risk. So there have to be negative correlation between the assets in the portfolio before the risk can be significantly reduced. Now, what I mean that I will show you what I mean as a real life example of negatively correlated portfolio diversification. I will show you the real life meaning of diversification based on negatively correlated assets and diversification based on positively correlated assets. Let me show you this example. Suppose you have your portfolio, you are given $20,000 to invest. This one, which is what I call the negatively correlated assets. Correlation will be -1. I have row. I probably have row here. Let's say the row is -1. It's negative equals -1. Sorry, positive equals +1. Okay, +1. In that case, when one increase, the other one increase and 5%. So let's say that you have $20,000 to invest. You now divided it and invested $4,000 in Bank of America. The other $4,000 in Capital One Bank, $4,000 in West Fargo Bank, $4,000 in Ali Bank, and $4,000 in M&T Bank. This is the typical example of positively correlated asset because you invested in one industry, which is the banking sector. If the banking industry have problems, all your investment will be down. So the risk is not reduced. Even if it is invested all the assets in, let's say, in a grocery industry, let's say the grocery chain like Walmart, Aldi, in retail, let's say in retail industry. If the retail sector is down, all your investment will be down. If it's up, it will be up. So this is a good example of that when they are positively correlated. But if suppose that you say, no, I'm going to invest 4,000 in Coca-Cola, 4,000 in Johnson & Johnson, you are saying this, okay, 4,000 in Philip Morris, 4,000 in Bank of America, 4,000 in Raytheon Technology. See, this is a good example of negatively correlated assets, okay, because they are not in one industry. This is a good diversification. So if the industry that, let's say Johnson & Johnson, which is in pharmaceutical, if the pharmaceutical is down, it will affect only Johnson & Johnson. The other stocks will be up. If Bank of America, the banking sector is down, it will only affect the banking. This is negatively correlated assets. It will affect only the Bank of America. The rest will be up. There's no way all of them will be down, except if we are in a recession. Okay? If other than that, they won't be down. Let's say that the groceries, consumer consumption good, confectionaries, let me put that way, sector is down. That means the Coca-Cola will be down. The rest will be good. For example, this Raytheon, which is in defense, it will be good because now with all this war in in Ukraine and Russia, defense industry are really doing well. How about this Philip Morris, which is a cigarette company? It will still be up. So putting your investment in only one sector is like investing, is a bad diversification because you are investing in assets that are positively correlated. But spreading it in different industries is good form of diversification because you are investing in assets that are negatively correlated. I believe you got the point by now. Okay. So if a portfolio standard deviation is less than the weighted average of the individual stock standard deviation, then the diversification is provide benefit. What does that mean? Mean that suppose you have an asset portfolio that you invested and you have the standard deviation of that portfolio. Then if that standard deviation is, you also have the standard deviation of the individual stock that are in that portfolio. If you add up this standard deviation of all those individual stocks, if you add their standard deviations and the portfolio's standard deviation is lower than that, that means that diversification will provide a lot of benefit for you. Okay, that's what it's saying. Having said that, we can move on so we can look at the risk. So the correlation between most pairs of companies are usually 0.2 to 0.3. So diversification can reduce risk, but it does not completely eliminate the risk, but it can reduce the risk significantly. Let me show you a proof of what I just explained about negatively correlated assets give a better diversification, but positively correlated assets give a less, a bad form of diversification. So look, it's using the data shown on the next slide. That's this one here. This one, asset A, 20% risk, standard deviation, and the weight is 1/3. Asset B, 10% standard deviation, and the weight is 2/3. Okay. So using this, calculate the portfolio risk for the three cases. Case A is when the correlation coefficient between A and B is equal to 1. Case B is when the correlation coefficient between A and B is 0. And case C is when the correlation coefficient between A and B is -1. So when when you have this form of correlation, these three cases, which one will give you a better risk reduction due to diversification? So let's look at each of them. So I'm going to put this. Remember the formula here. The formula is this: dp equals to square root of all this. So plug in the numbers that represent all this, okay? And this side, we are giving these numbers here. So we have, for in this case, the portfolio risk is, okay, risk delta P equals to weight of asset A squared times the standard deviation of the assets. Okay. Then weight of A squared and plus weight of asset B times the standard deviation of the assets squared. Okay. Then plus 2 times weight of asset A times weight of asset B times the correlation between asset A and B times the standard deviation of asset A times standard deviation of asset B. So we are given that the we are given that for this asset A, the standard deviation is 20%, which is 0.2, and the weight is 1/3. So we're gonna put it here. 1/3 squared times 0.2 squared plus for asset B is 10% for the standard deviation, and the weight is 2/3. Say weight is 2/3. Say this for this and this for that squared. So repeat the same process here, put the weight and asset, but we don't have any value for their correlation, so we'll leave it the way it is. So let's figure this out. Let's figure this part out, and this part also with this one not given. For this one, we have, I'm going to take you to where we can do the calculations. I wrote it down. So we have, okay, so we have this weight. 1/3 squared. Okay. 1/3 squared times 0.2 squared. Okay. Plus 2/3 squared. Squared plus, oh, excuse me, times, okay, times 0.1 squared. You can see 0.00888889. So I'm going to stop at the fifth decimal place, which means 0.0088. Sorry, I'm going to stop at the fourth decimal place, which is 0.0089. And you can see it here. Okay, 0.0089. So I repeat the same process for this side, but remember, we don't have the value for the correlation coefficient row AB, but we're going to multiply the numbers out anyway. So have it in this form. got 2 times. We have 1/3. Excuse me. 1/3. Okay. Times 2/3. Time. Okay, I think this is it. Times, okay, 0.2. We still have the 20% and 10%. So I have times 0.2 times 0.1. Say 0.00888. So the same thing we have. So 8. So I'm going to stop at this 4 decimal place, which is 0.0089. 0.0089. That's it right here. But we don't have the value for AB, so we leave it the way it is. So this is what we're going to use to assess the result for the 3 cases when the correlation is +1, when it is 0, and when it is -1. Okay, so case A is when it is +1. If the correlation coefficient is between A and B is +1, it means that when the value of the price or the asset increases, so does the value so the asset B. So when one of them increases, the other one also increases. So that to calculate the risk, we have it. So when we plug in +1 here, and that will give us the result. So we have the result as square root of 0.80089. Okay, plus we have 0.0089 times 1, because the correlation is 1. Okay, give me 0.1334, which is a risk of 13.34%. So when we repeat the same process using the case for case B, when this correlation is 0, we plug in 0. What we're gonna get is 9.43%. So in this case, the asset lack correlation, and the portfolio risk is simply the expected return on the assets. But when it is -1, say for case C, when it's -1, that means when you plug in -1 instead of 1, say this is make this -1, -1, you can see that the risk is 0. See, that means that if it is negatively correlated asset, if that of those assets are all negatively correlated perfectly, the risk is 0, which means that the risk is completely eliminated. So when we compare part A, B, and C, we see that the positive correlation between assets increases the portfolio risk above the value found in the 0 correlation, while perfectly negatively correlated assets eliminate the risk. See, so that's why I explain. I give you the example. Real life companies, I choose how to diversify to reflect negative correlation between the individual companies that make their portfolio. So when it comes to multi-diversification and multi-stock portfolios, we say that in general, the risk of a portfolio consisting of large company stocks in general tend to decline and to approach some limits as the size of the portfolio increases. That is why index funds are usually less risky than the actively managed funds. My opinion. Some asset managers may disagree with me, but the fact is there for everybody to see. So Now, I wrote here that almost half of the risk inherent in an average individual stock can be eliminated if the stock is held in a reasonably diversified portfolio. Usually, it's 40 or more stocks in different industries can eliminate a lot of risk. So the example I use here, I use assets, only 5 assets in 5 different industries. That because the amount to invest is really small. But if there's some mutual fund that if you put 20,000 there, invest it, spread it even more into up to 30 different industries investments. And that may give you more diversification and less risk. Okay. Index fund will even give you more than that. You have a slice of every market. Okay. All right. See. So in the next lecture, we'll be looking at the types of risk in the market. Okay. I hope you enjoyed my lecture today, and thank you for listening. And I will see you in my next one. You guys have a nice evening.